All right. So we've kind of turned the corner on personal finance in terms of most of the stuff we've been talking about has been how to save money, how to, spend money more wisely, and the rest of that. We haven't necessarily talked so much about how to make money, income. The basic gist of it is people generating wealth. They don't do that, on the clock. They don't do that via W-2s. I mean, you can work pretty hard, very hard, but especially if you're working for somebody else, they're going to pay you almost what you're worth, and then a little bit less. You're never the really wealthy folks. They did make their wealth, working for it necessarily. They generated some money. You need some seed money to get the thing started, and then they had their money working harder than they did, which is kind of the concept. You need your money you need to look at it as a resource to generate more money. And again, you're not trying to be Scrooge McDuck here. You're trying to do some good with it and concentrate on other things. But obviously, as we all know, if you have a bit of money, it's something you don't necessarily have to worry about. As I've said before, people who don't want to worry about money end up worrying about money a lot because they don't, have enough to get by or perhaps enjoy the things they want or provide for people. So, investing in stocks. So, like it or not, some people have that gambling instinct, and I'm trying to, suppress my inner degen, my investor that wants to be completely speculative and all that kind of stuff. But then again, if you're too far on the other side where you're so conservative and the sky's falling and I'm just going to save the money and no, either approach is going to end up in doom. If you overinvest, or not overinvest, invest is a good word, but over speculate, over gamble, you're probably going to run out of luck and lose it all. But by the same token, if you are so conservative that you just hold on to your cash, inflation is going to eat up that money. And other people, essentially, when you're saving that money, you're making it available to other people to invest more wisely than you, and they're going to be, enjoying the benefit of your labors, and you're going to be struggling the entire time. So you need to find a balance. But again, this isn't about gambling or speculation. If you're one of these people who needs to go to Las Vegas and spend a bunch of money or whatever casinos you like, try and fight that urge. Realize, all that. I'm not really all that impressed with Las Vegas, to tell you the truth. I just don't like all the man-made kind of structures. I'm much more impressed by, mountains and natural creations rather than, some sort of stuccoed over styrofoam garbage that they have in Las Vegas. But anyway, that stuff is expensive, and where did they get all the money to buy all those spheres and everything else? Yeah, that came from you, the gambler. They're not really gambling. They're taking a percentage. They are insured of winning. So if you have those sort of tendencies, maybe try and channel that into the stock market, where at least it's a even playing field, and we'll work on that. Okay, so we got to start from the basics. The book and just sort of the traditional approach. We're going to go through it, but I'll tell you what's important, what's been kind of updated by technology. Things are getting better all the time. And crypto especially is kind of forcing some of these old school notions, commissions and delayed trades and all this stuff. It's just, it serves nobody. So a lot of these things are going away. And so it used to be that you needed to be a huge institutional investor to use all these sophisticated techniques, and retail investors, the small guy, you kind of had to stay in your lane, and they didn't want you playing in basically in their sandbox. There's a pretty good movie. It's more entertaining than accurate, but it's about the GameStop type thing. GameStop was the retail video game sales thing, and the Roaring Kitty. He got involved in all this. He was just a stock trader, but a super smart guy, individual retail, and he was working for a big company. But how fun is that? You're making a ton of money for the corporation or your boss. Very rarely do you get to keep any of that. Again, they're going to pay you just what they need to, and then a little bit less. And anyway, if you're out on your own, he was an investor and got a big group of people together and did some pretty interesting stuff. The reason why I say the movie's not completely accurate is because guess what? The big boys, they saw what Roaring Kitty did, and they jumped in, and there was a lot of money made in that trade, but it just ended up going a little bit to the retail investors, the small guys, but most of it went back to the bigger players who completely took advantage of the situation and saw what was going on and crushed it. So anyway, we'll look at that. So stock exchanges. This used to be a big deal where you had to have a seat at the stock exchange, and that was expensive, and you had to have a representative there, and technology is just driven that to where it's not such a big deal. You needed to be listed on the New York Stock Exchange. And a floor trader, these are the goofy guys that yell and do all this stuff. There's still some of that, but a lot of it's electronics and whatever. I sound like Elon Musk or Trump computers. Anyway, it's not quite like that. Now, there still is a central trading place, that central computer, and people will pay astronomical sums to have a trade platform located closer by cabling distance from that, because even though electricity goes at the speed of light, 186,000, whatever the units are, 186,000 units per second, a few meters of cable makes a difference. It's funny because they'll do really creative things like front run trades. They'll know your trade's coming in, and they'll put a trade in just beforehand. And anyway, that gets way beyond the concept of personal finance. So location and geography is still important, but having a guy on the floor, those kind of things, no, not. It's still there, but it doesn't do it. Specialists, people who are different markets. There are other markets like commodities and things like that might be in Chicago or other places. But again, a lot of stuff is now just done electronically. Even outside of the New York Stock Exchange, it's done over the counter or NASDAQ, different things. So there are other stock exchanges. Do not, whatever. You can do what you like, but trading on foreign exchanges, like in foreign countries, trading stocks is already complicated enough. You start taking in currency risks and other things. They're not talking about foreign exchanges here. They're talking about, other large cities, because there are some regional exchanges. But for me, I don't care where the exchange is located. I don't necessarily. I'm not going to choose a stock. There is some credibility for having a stock listed on the New York Stock Exchange, but again, the companies that I'm most interested in, the ones that the up and comers. They may aspire someday to be listed on New York Stock Exchange, but by then they're going to be kind of big, sluggish companies. I'm more interested in the smaller stuff. And so again, it's a much more aggressive type thing. But if you're looking for a stable company, being listed on the New York Stock Exchange might be a plus for you. And then the OTC, over the counter. So this just means primarily, these guys, this is just kind of where most current stock traders grew up. They're used to over the counter. At first, all the old boomer dudes or pre-boomers, whatever we called them, that have probably passed by now. They were, a little hesitant with these kids with their computers and stuff. So a little different. Market makers. These people still exist, but they exist in the background now. And this is what they're talking about: less stringent listing requirements. So that might be, if you're running a huge pension fund or you're an insurance company and you're investing in things, and you lose money. Losing money is one thing, but if they do a review and they say, oh, you're invested in a bunch of garbage stocks, they're not even listed on the New York Stock Exchange. So, yeah, you might be putting your job at risk because people might say, hey, you're investing in not super well established companies. But again, there's always a trade-off. Electronic, so. Yeah, after hours trading. So the normal stock exchange is driven by the East Coast. So if you're here in Alaska, yeah, you're getting up early. The markets close at basically 12:30, and I think they open up at about 6:30 local here. So you add 4 hours onto that to get back to the East Coast. So they're normal business hours, closed on weekends, closed on holidays, all that other kind of stuff. The problem with after hours, and in fact on most of the platforms, if I try to trade stock, they'll put in like a cautionary note saying, the volume's so thin. Meaning, so if you put in an offer, well, not an offer, a trade, and let's say you're trying to buy some stock. I used to Twitter before it became X. I would buy and sell that quite a bit, because it played this range that I'll talk about later. But anyway, I would try and buy it at 35 and sell it at 70, because it just kept bouncing back and forth between those two, and who knows why. People try to figure out why stocks move the way they do, but when you see a apparent pattern start to develop, sometimes you can glom onto it. And anyway, so I'd put in a buy order to buy at 35 or whatever, and I'd put in a limit order, or even a market order. Market order is more dangerous, because a market order means you put in the order at 35, and it's going to buy right now. You just put in a market order. The 35 is the current price that it's trading at, and the price you buy it at should be around 35, because that's what things are going for. But you're buying the next available shares that come up, which is dangerous if it's a very thin market, because there's no volume. So let's say something comes up there for 37, and all of a sudden, boom, because you had a market order, you bought at 37. So anyway, I normally don't do after hours trading, but with crypto and things like that, it's completely normal. There really is no after hours trading. It's all 24/7. So again, as things become more electronic, after hours trading may go away. Kind of getting in the weeds on that one, but don't worry, not a big deal. Just for the most part, trade when the market's open, and it's a bit more efficient because there's more buyers and sellers. Price quotations. So I'll show you a few things of basically it's historical the way they used to do it. This whole thing about newspapers. Yeah, no. It used to be, this was one of the exclusionary things for retail investors, was that the stock quotes, in order to get them real time, you had to pay. Bloomberg terminals, the ticker tapes, all those things. People paid for that subscription. That wasn't available to the common person, and it wasn't that it wasn't enabled by. I mean, it could have been available, but they're not going to give it away when they can sell it to you. Well, the dam is broke on that. You can get real-time quotes, out there on the internet with graphing and everything else. That's far better. People will still pay for advice, for insight, research, but again, it's hard to find good quality stuff, because especially there's so much spam, so much speculation, and so much people trying to manipulate you on stock prices. So be very, very careful. But anyway, getting the quotes now is much easier. So previous day, yeah, this is so. I'll show you why what they're talking about here is just OBE, overcome by events. It's completely old. So here's how it used to be done. You go to a newspaper, so it's already a day old, and here's this stock, Zoogle. It's trading, a range, went from $62.10, so $62.10, and the low was 49.40. So pretty volatile. That's a pretty big. Oh no, that's over 52 weeks, so over a year. I was going to say that's a huge range over a day. It's paying a dividend, the yield, price to earning ratio can be important. We're getting more into technical stuff a bit beyond this course. Volume's kind of critical though. But it's only critical when you have something to compare it to. And this is what I'm talking about. If you see a huge price swing, but there's no volume, it's like, well, there was one knucklehead who bought it for too much money. It's not really reflective of the broader market. If the market is open, there's a lot of buyers and sellers in there, then the price is probably going to be more reflective of what it actually is. If it's, Christmas Day and you're buying after hours, be very careful. Okay, so this is what it closed for yesterday, so that's not good because, 49.40, it's 60 cents above the 52-week low, so maybe you're buying into the bottom, and that's 27 cents up, so it was, pressing down into the 49 something the day before. What was that, 49, whatever, 73? Anyway, broker, yeah, you don't need them. You need a brokerage, but this whole problem is stockbrokers. I used to have a stockbroker when I was in Saudi Arabia or Turkey or wherever, and I used to trade some stocks. And back in the day, we're dating myself. You had to use a broker, and these guys, I'd ask them for recommendations, and I was naive. These guys were pumping garbage that they had an interest in, and so I don't even think some of these firms got flushed out back in 2007 or so. But they'd say, "Oh, you need to buy this one. This is a good one. I've got kind of a hot tip on it." Anyway, so the normal process, I did this about 3 times. I'd buy some stock, the price would kind of flounder, probably go down, and then sure enough, I get a letter, 6 months later, a year later, about a class action lawsuit that Payne Weber or whoever these knuckleheads were misrepresented the stock. That they were trying to pump it up. Now, it may just be a disgruntled investor, but it may actually be some basically fraud on the part of these brokers who claim to have a fiduciary responsibility and claim to be representing you in your best interest. Realistically, they were trying to push something else. So, that, if you're a high wealth kind of person and you've got a proper broker who's making some money in the game, maybe he's being paid, you've got a subscription where you're paying them for their advice, maybe you're getting good advice, but if they're on a commission, they're whatever, they've got some commissions that are maybe clouding their judgment against you. So anyway, it's like anything else. One thing with they use this term, the internet, the capital I, all the time, but what the internet has done is it does allow you, sitting here somewhere in some village in Alaska to have access to the same information as the guy in New York. So it has kind of evened the playing field. And perhaps, the knucklehead and wherever is not the person you need to listen to. You only need the advice of one person, and finding that person, or perhaps you'll be the superstar, and one day this will be you. But the advent of all this analysis, though, especially with technology, there's a lot of frustrated math professors and guys that just are super genius, and they're in the educational world, and frankly, they felt like they were getting underpaid, and they felt like intellectually they were far superior to these people in finance. So a lot of these high-powered math folks have migrated over to Wall Street, basically, and technical analysis and the algorithms and stuff like that. These guys are on it, and you're seeing some of the the brain power that developed nuclear weapons and things like that now are fully harnessed towards greed and in the market. And so some of these technical trading programs are just freaking amazing. And if they're really good, they're not going to be on some YouTube course sharing their secret strategy with you. No, they're just out crushing it, and they're doing just fine, and they're not trying to share that data. So that's kind of the, again, it's tough to find. So brokerage commissions, yeah, don't pay it. Basically, this whole discount brokers, they used to have discount and full service. Pretty much everybody, there are no commissions on trading stock for the most part. I mean, you can, if you want, find somebody to take your money, but you can trade on most every platform without a commission. So these guys, they just went a little too hard, and now that being said, if you're kind of a novice or you want confirmation of some of your, semi-wacky ideas, you can find folks out there who do analysis, and perhaps rather than pay them commission, because you don't want somebody who's incentivized to have you buy and sell, things just to buy and sell things. They create a churn, and you just pay a bunch of commissions. No, you want somebody that you're paying whatever, maybe even on an hourly thing, like a lawyer or whatever, where you're paying them, I don't know, some rate or some subscription per year, and when they give you advice, no, don't do that. That's probably somebody you can trust, rather than a stockbroker who's going to say, buy this, sell that, buy this, and at the end of the day, all you've done is generated a bunch of sales and things and commissions, so not good. Placing an order, dead easy. I'll go through on the slides and kind of show you how to do this. Even the ticker symbol, again, the internet will help you out with this. You don't need it. The ticker symbol is a abbreviation for the stock. Like, some of the big boys, especially companies that have been around for a while, like F. The letter F is actually a ticker symbol for Ford, because Ford's been around forever. But other stocks that are more current, it's probably going to be something related to their name, like NVIDIA, NVDA. I've got C Limited, a small company out of, I think they're out of Singapore. Anyway, SE. But anyway, that's an example of a ticker symbol. But don't let that be a barrier. The internet's quicker with that than you are. Buy or sell? Yep. Are you buying or selling? Number of shares? You don't have to do this odd lot anymore. It used to be there was a surcharge. Now you can say, I want to buy $100 worth of something. I still don't do it. I don't know. I still use their little calculator and figure out, I want to buy $10,000 worth of something, and I'll just use the little calculator feature on the order platform, and it'll say, yeah, that'll get you 87 point whatever shares, and so I'll just delete that and put in the 87, so I buy a number of shares. But this whole thing of doing the multiples, computers don't care. Only people need to work in kind of round numbers. So this is example of what I was talking about, why that chart, or not chart data, why that tabular data is just, worthless. This is so much more powerful. In fact, let me step out of this. So this is NVIDIA. So there is that ticker symbol, NVDA. But it doesn't take the computer any extra to type it out for me. NASDAQ, so it's traded on that. That actually stands for National Association, Anyway, dealers, and it's a OTC. It's a electronic exchange without a physical, location. There aren't traders. There aren't goofy people out there doing that. We're seeing the data, and this is over the course of a day. This gray area, see, the stock market closed at 4 o'clock. So now they're like, ooh, you're in after hours trading. The price is still, there are still some people making trades in here, but you don't see a bunch of swings because, most people aren't trading in these after hours because it's a weekend. I just pulled this like a few minutes ago. Previous close, the day's range, year range, market cap, all this other stuff, that P/E ratio, price to earning ratios, dividend, and they're not paying. They're still growing. And some of the competitors. So let's step back and look at, Okay, try and get this thing to and show for a second. I've got a couple pulled up. So there's some competition here. This was, well, Metaplanet. Okay. Again, I'm taking you right down the GGen platform here. Metaplanet is a company trading out of Japan. It's a company based in Japan, but they're trading on a U.S. market. So all those tax implications, all that currency fluctuation, that goes away because they're trading in U.S. dollars on a U.S. platform. We could trade on these if I typed in, Metaplanet. So not to be confused with Meta, which is what Facebook now. So yeah, you could trade it on the Tokyo Exchange. Don't do that unless you want to, pay an accountant and a lawyer and everybody else to sort it out and deal with the currency fluctuations. France, but wait a minute, so that sounds like it's traded on the German exchange, Deutschland. But anyway, you would obviously want it priced in yen and whatever. Here's one priced in euro. No, you're creating find the one on the U.S. exchange. So pick a company. Now you're not going to find all companies. Like anybody who's flown drones knows that DJI is a great company. But no, they're not listed. They're privately held. At least I still think they're privately held. Chinese company. So some companies, they aren't public. They aren't publicly traded. Their money is all in private hands. So you may not be able to jump in on any company you want, but some you can. Let's go back to NVDA. So on this, you can look at that, but you go, well, this is good now, because our brains kind of work. We can see the graphical data. That's a little easier to see, but let's look at why I might want to invest in this company. Now, stock prices are always forward-looking. So this has been a rough year. This is year to date. And so this starts back in January. And so, yeah, things are down a little bit. That's why I bought a little bit of this just recently, because I think we're in kind of a downswing right now. And so I'm trying to buy the dip, buy down at the bottom. But if you get out to a broader scope, you're going, whoa, this looks pretty good. Now, what's super powerful about these charts is, here it looks even better. And I think I bought my initial stuff way back when. Now, NVIDIA is kind of unusual. I'll talk about something real quick here, and then we'll revisit it later. But NVIDIA, their stock price was just zooming, And so let's look at it, just 5 years. And what happened was that the share price got up over $1,000. And so it was just kind of ungainly. So what they did was a 10-for-1 split. And they said, okay, if you had, one share of the stock and it was priced at, $1,177, that's what we're going to do is we're going to do a 10-for-1 split. Don't worry, you're not losing any money and essentially you're not making any money, but what we're going to do is we're going to give you 10 shares for every one that you used to have. And so that takes their stock price down to 117. So they did their 10-for-1 split back wherever. The charting people, because again, it's a computer, they're all over it. They know exactly what happened. And so the old prices are all calculated out. The first time I ever bought NVIDIA, it was back in, anyway, I paid $32 a share for the stuff. So you'd have to take it back to take it back for a while. I didn't buy that much. I wasn't that prescient, but I want to say I bought here in probably back in 2017 or something. So I wish I would have bought more. But anyway, that's the power. Now I've had other stocks that have done not so well. Let's look at one. I went big with these guys, Sea Limited. They're a competitor to basically Amazon, but they're located in Singapore. And yeah, things went horribly wrong. I was buying in, gubbing up here. Now, in the long run, I think their company's going to come back. But yeah, that was not one of my smarter trades. So you certainly can lose. But if it's a good company, there is a chance it will come back. If it goes out of business, it's game over. Now, other things you can get from these charts, because like here, for example, there's more to these charts than you realize. Like you click and hold, it'll take those 2 points. It froze that 1 point back there, and it said, yeah, you're down damn near 60%, 59.33 from, November 19th of 2021 to, and that's kind of sort of where I bought, unfortunately. But that one's going to come back. And again, that's where diversification. You make money on NVIDIA, you lose some money on C Limited. Again, if you do something like, let's say, I don't own any AT&T, but a more stable company, that didn't want to come up. But you'll see why, most folks don't invest in the sketchy stuff like I do. AT&T's for some reason now it thinks I'm in Vienna Stock Exchange. Whatever. It's good for illustration purposes. But see how this company is, well, it still has some rocky path. So whatever. AT&T is not something I track. Let's get back to let's go back to AT&T and get it priced in dollars so I don't freak anybody out. But see how it's traded on all these different exchanges. And it's carrying different tickers in different countries. So maybe I kind of buy. Yeah, look at that. So AT&T, big company, been around a bit. Yeah, what's their ticker symbol? T. I mean, that kind of, when you're a single alphabet kind of thing, you are an old established company. You've been around a while. And their volatility is whatever. It'd probably be a good stock to have. They had that slump. I don't know what happened back here. Some bad decisions, and then all of a sudden it came back. But if you want to look and see what happened, you have access to some of the news. Seeking Alpha, different companies that might help you out. Get down to their financials. And this is all available for free without, an account or whatever. And then it may show you some competitors. One last thing I want to show you on this while we're on the charts. Let's say you go for a sector. You're going to be buying a mutual fund. And again, you don't know what the, what's going to be the dominant company within the, AI, microprocessors, semiconductors may be a big deal. So you want exposure to that whole sector. So you may buy a mutual fund that's got a variety of these companies. But if you want to compare it to another company, it's putting some other tech companies in here. I think more realistically, I'm looking for, I want to put in AMD. AMD is Advanced Micro Devices. They also make chips. Yeah, AMD. And so, yeah, here's their prices. They're both kind of doing, but that's just on a 1 day. Let's look at a 5-year. Whoa. NVIDIA seems to be, seriously outperforming those guys. Broadcom. I mean, you just start tapping them in here. And you can see why, yeah, I was, lucky, good, whatever. But I picked NVIDIA and pretty happy with it. If I owned the mutual fund that owned all of these, the mutual fund would be doing well, but not as well as if I would have got lucky and picked the single one company. So this is Google. I think they get some of their data from Yahoo, but again, these companies are out here. The thing I like about this chart, maybe it's more of an eye chart, maybe there's a lot more going on here. I guess it's in dark mode, but see these little candlesticks along the bottom? That's kind of cool. That's showing me volume. And so if I see a price in here, I can say, oh man, there's a ton of volume, something happened. Well, something fell hard right in here. This was a big, somebody dumped a bunch of stock at around whatever day that was on 3/21. Probably market open or something. Again, you can scroll along, 1 day, 1 month, 3 months, 6 months, year to date, year, 5 year. Anyway, But having this volume information is also kind of cool. So just a ton of stuff. Technical analysis, indicators. I mean, again, beyond the scope of this course, but lots of information that was not available to the retail investor. I'm not a technical investor. Technical investors are people who watch chart patterns and things like that. And I was never a big technical investor. I was more of a fundamental. Fundamental means like, well, I think this company's got a bunch of potential because, world events, things like that are outside the scope of just looking at a historical chart. And anyway, the best is to have a combination of both. The technical analysis, as much as they say it's math, it's really based upon human psychology because it's people that are executing the trades and all that. Okay, so we kind of went through that. We talked about charting stuff. Probably bored some of you. Maybe some of you are going, wow, this would be kind of interesting. That's up to you. Here, let's say, we're serious about this. Now, this is just from a little while ago. Actually, I think it was from last term. And I just put in a screenshot of this is from Fidelity, but whatever. I type in the symbol. So again, this is back when I bought. So it's much less than 1,000 then, and it's way above 1,000. So, giddy up. We're making a little bit of money. So we typed in NVIDIA. We decided we wanted it. This was a drop-down menu, so I was going to sell, buy, whatever, quantity. Now I can type in, I want to buy 70 shares, or I can go over here. Now all these different websites are going to have some variation of this, but here let's just say I hit this thing, the little calculator-looking thing, and it's going to come up with quantities. It's going to come up with dollars, and it's going to come up with shares. You type in one or the other, and it tells you how many shares. And so anyway, that's what I was saying. If you've got $10,000 to spend, $3,000 to spend, or invest, not spend, you would type it in there and it'll come up with a share thing for you. Order type, that's what's going to be over here. We'll talk about that. And then time and force, if you're using some sort of more, not complex, but more than a market order, you'd put a day or GTC, good till canceled. They do use some acronyms in here, but not over the top. Good till canceled basically means 90 days. They'll send you an email and say, hey, you've got an order out there. Do you still want this thing to be in place? So what would happen is, let's say I want to buy or sell, so I hit the appropriate block. I want to put in, 70 shares. Pick your number. If I just want to do it right now, next available time, I hit market. Boom. It goes to the market. Now there's kind of actually it tells us right down here, kind of a gut check. It's because it's you're going to put in, you're not actually putting in a price. You're looking at the current price and you're going, yeah, I want something around there. Boom. And so the price you go for in a heavily traded market is probably going to be really close to that. If you're trading on a weekend or thin volume, it may be some distance away from that. Or if it's a really not popular, not heavily traded stock, you can get in some danger by doing a market order on a thinly traded stock. What you can do, and again, I don't like to do this because I'm kind of going with momentum. I see the price dropping and I'll put in a limit price. And let's say it's trading for, it seems like the day's range, it's trading between $69 and $71. I'll say, okay, I want to buy at the low end, right? I'll say, actually I've got sell ticked up here, so I want to sell at the high end. I'll put in a limit price. I'll put a limit order, and then I'll put a limit price of 71, meaning I want to sell, but at 71 or higher. And if it hits that price, boom, my limit order becomes a market order and is executed on the next trade. So is it going to be right at 71? No, but pretty close. Stop loss. Let's say I'm making money, but I'm going, man, I've seen this before. This stock is cyclical. It goes up, it goes down. I don't want to get screwed on this one. I've made some money. I want to keep it. And so what you do is you put in a stop loss, and let's say it's marching away. It's going, 75, 76, 78. You're like, that's cool. But if it, I think it's going to keep going up, But if it starts to come down, I want out. I want to, preserve. If it drops below 75, I want to be out. So put in a stop loss. Boom. So trigger price market order when price is reached. It can be used to help manage. So, this can work either up or down, depending on whether you're buying or selling. Anyway, it drops down to that limit, and boom. Stop limit, just a little different, just slightly. When specific price is reached, so very much the same buying and selling type differences. This is kind of interesting. And if I would have taken my own advice, I would have done this and not gotten clobbered on C limited. What you do here is you see this price edging up, and you're kind of watching this thing like a hawk. But you got things to do in your life, So you see the price, move up. It gets to 75. And so you put a stop loss at 72. You're sort of trailing it. And then you see the next day that, now it's at 78. So you move your stop loss up to 75. Number one, you probably got your stop a little too close because there may be some fluctuations and you don't want to have that thing triggered. But anyway, so you should spread that out maybe a little bit more. But let's say, you got things to do with your life and you don't want to sit there and watch the market all day, or sometimes this stuff could happen after hours. So you don't want to worry about that. So you'll put in a trailing stop, either expressed as a percent or a dollar. And you'll say, okay, this market's, this stock is going up. And what I want to do is I want to put in a trailing stop that's kind of ratchet behind it. And automatically, let's say I put in a 10% trailing stop. It's going to get the current price. Let's say it's 75. It's going to go 10% lower, so $7.50 lower than that. It's going to put in a trailing stop right there. So if that price gets down 7.5, whatever, gets down to 67.50, it's going to execute an order to sell and get you out. But if this price, let's say the price goes up to 70, well, your trailing stop, obviously it didn't drop down to that price. Well, no, I'm sorry, we're going up in this case. Let's say the price goes up to 80. It's doing what you want. The price is moving away, going higher. Your trailing stop is now going to establish a new trailing stop behind it. And again, if it's at 10%, 10% of $80 is $8. So it's going to establish a trailing stop at 72. Meaning if the price descends to 72, it's going to execute. But let's say, 3 weeks, a month later, things are still going great. It's up to $90. Your trailing stop has continued automatically, as long as it's enforced, to automate and go behind this price. And so stock's trading for $90. You've got a trailing stop in there at your 10% that's going to execute at 81. So it's kind of neat. I mean, you can do a lot of semi-automated trading if you want. I mean, there's a lot more to automation, but that's just an easy thing that's available to anybody. And so it can be expressed as a dollar amount, a percentage, and then stops and limits. Trying to fight this cold and it's not working out. Anyway, purchasing and selling stocks. So this, again, we're getting back to the book description. I kind of showed you how to do this, so this should be exactly, what I said. Order, buy, sell. It's market price right now. Limit, buy or sell only when the price is within the limit. So, again, a little more concise definition than me rambling. Stop orders. Price to a specific level. Yep. It's a special form of a limit order. It is. And then they don't get into trailing stops because that's probably behind them. Yep. Sell, stop. So we sort of talked about that. Place an order online. Low commission. Yeah, no commission. If you're paying a commission, you're messing up. You don't have to. Buying stock on margin. for the most part, do not do this. That's using borrowed money. So what happens here is the Federal Reserve means you need to have 50%. So you want to buy, $1,000 worth of Tesla, and you're going to do it on margin. Well, you need to put up, let's say you want to buy $5,000 worth of Tesla, and you want to buy it on margin, and you're going to max the margin out. So you're going to put up at least $2,500. Well, your margin is identified by that cash that you put up, the $2,500. But now it's being held in Tesla stock. So the amount of money you borrowed is still, the $2,500, but the underlying cash that you've got for that is denominated in Tesla stock. So if the Tesla stock price goes down and you're already at the 50% margin, you got to come up with some more cash to get back up to that Federal Reserve limit of 50%. Meaning that you're going to get a call from the broker, an email, or an alert saying, hey, add some money to this account or you're going to be stopped out. We're going to sell these shares unless you get back within compliance. So if the stock starts going the wrong way, you get stopped out, and you get stopped out at the bottom. So I don't like buying anything on margin because it's just, there's already enough volatility. I don't need that part. But a margin call means that you need to put in more cash to get your limit, your margin back up to 50%. And so it can get quite dangerous. I really didn't talk about that. Let me try. This is, and I don't mean to get political, but you guys should not get political in purchases. You can have your own political feelings, your own emotions, and everything else, but don't let it influence your investing. Because a company like Tesla, regardless of what you think, there may be some money to be made on this, and some of the smart people are perhaps going to do that. Because if you look at the stock price, again, I'm not a huge Yahoo fan. I just like I think they get the data from Yahoo, but the Google charts are just more intuitive for me. Anyway, I think I bought at $235 last week or so, and I don't know whether it's going to be the bottom. Yeah, it got down to $222. But again, I'm not a huge proponent. Fundamentally, I'm not a big fan of EVs, but they did come out with a drone. But this is definitely a speculative move. But most people think that it's probably going to march higher. Now, again, I guess on the 29th, so 6 days from now, there's going to be a big protest. But will it last? Will it not? Will the lack of charging stations, the basic infrastructure, but it's just a very strange situation that environmentalists are burning cars and anyway, I don't pretend to understand. I'm just, it's for people who sit there and watch the news every freaking day and obsess over it. It's kind of a huge time suck. Why not try to, make some money off the situation rather than fret about worthless blog posts. That's kind of how I ended up with my PhD. I was down in Afghanistan, and I had a friend who was, he and I politically were probably on the same side, and he was out there arguing with one person or another, on blogs. I'm like, what, why don't you apply your efforts rather than trolling back and forth with some other fellow, idiot online? Why don't you apply that to something productive? And so anyway, I started my PhD down there, and then I finished up. So anyway, he and I, whatever, I would say that my process worked out better. Short selling a stock. This is interesting. So again, you'll see this if you watch that GameStop movie. I think that's the name of it. I'll look it up. But you can sell, let's say, and I did this one time with Tesla, so I'm not like in fact, I'm probably fundamentally not a huge Tesla supporter, because I think they a lot of their initial development was done with subsidies, with a lot of federal money. and there was an election, whatever number of years ago, and and I thought the subsidies were going to be cut off, and Tesla was going to flounder, and their stock price was going to go down, at least in the short run. So I sold it short, meaning that I expected the price to drop. So what you do is, I can't remember what Tesla was trading for back then, but I sold some stock, but I sold it short, meaning I sold stock I didn't actually own at that point. I bought whatever number of shares, like say 100 shares of Tesla, but I didn't pay for them then. And this is conceptually how it works. I did have to put out some money, but anyway, the way it works with short selling is you get the stock now, but you pay for it later. If you're selling it short, you're anticipating that, let's say the stock's trading for $500 a share. You're anticipating that you're going to be able to buy these stocks in the future for $400. So boom, you know when the bill comes due, you buy these shares, but you buy them for the future price that's lower. That's if things go well. If the stock price goes high, oh boy, now you have to put those shares, buy those shares to the higher price. So again, short selling, the only reason I'm really talking about it is because you may see, it discussed in some of the mutual funds. I don't expect you guys to be out there doing short sales. I personally don't like it because when I'm doing short sales or buying futures or things like that, you are in number one, a zero-sum game, meaning there's a winner and a loser on each side of the trade. I'm betting the stock's going to go down. There's somebody else betting the stock's going to go up. One of us is going to win. We can't both win. Whereas if I bet on NVIDIA and the stock price goes up, we can all win. We can be on the same side of the trade. But I don't like going mano a mano versus some guy who's, does this for a living and nothing else. I'm fairly confident in what I can do, but I don't want to, bet on the fact this guy's got better information or something else. I don't want to go there. So, but yeah, short selling, futures, it's all super interesting stuff. Commodities, but again, kind of beyond the scope. But it does, it provides a useful financial thing. For example, let's talk about buying on the futures market. This is typically done in commodities, but what you would do here is, let's say you're a big airline. Delta Airline wants to sell tickets for next year, and they want to have these tickets at a competitive price, and so they're gonna try and Nats ask this price exactly to what it needs to be. Well, obviously, flying airplanes is heavily dependent upon fuel prices. So what Delta Airlines will do is they'll say, we want to buy, 1 million pounds, 1 million gallons, however they're going to commoditize it, of jet fuel for delivery in March of 2026. And let's say jet fuel, I don't even know what it goes for. Let's say it's $5 a gallon. They'll say, we'll buy 1 million gallons of jet fuel for March 2026 delivery at $5 a gallon. And somebody out there, a market maker and then an investor on the other side will say, yeah, I'll take that bet because, jet fuel's trading for $4.50 right now. I think the price is going to be stable, perhaps go lower. And, I'll guarantee, delivery of that 1 million gallons of jet fuel at $5 a gallon for March 26th delivery. And if that price goes up or down, that dude on the other side of the trade still needs to deliver. So what that's done for Delta now can price their tickets with a fixed quantity, knowing exactly what they're going to be paying for fuel because they've locked that in. They took that speculation out of it. So there's a business case, a business use for that type of futures trading and commodities. And so that's how it works. And like short selling, another way to explain this is let's say just a simple example. Let's say you want to buy your neighbor's house is coming on the market, and you know, it's got some intrinsic value to you because it's the neighbor place. You want some control. You've always wanted it, but you don't have the cash right now. What you can do to this, you know, for your neighbor is say, hey, you know, you want to sell your house for whatever, $500,000 today. Say, look, I'll give you $525,000 for that home 1 year from now, and if you'll take it off the market, and you know you don't want to get in a contract where you're going to say I'm absolutely going to buy it. What you prefer to do is say I want the option to buy it for $525,000 a year from now, and in consideration for that, I'll give you, you know, $10,000 today, non-refundable. So, if you will take it off the market and agree to sell it to me at $525, if I want, you know, I have the right but not the obligation to buy it 1 year from now for $525,000. I'll give you $10,000, and you can see that your neighbor might go, well, that's not bad. I'm going to come out $10,000 ahead, and you know, I'm locking to the price that I'm going to sell it a year from now, but I'm fine with that. And if the market goes to crap, well, then your neighbor is probably not going to execute that. But if the market goes up to that house is now worth $6,000, your neighbor who paid the $10,000, he encumbered you. He's got an obligation. You've got an obligation to him to sell it to him for $525. So anyway, all those sorts of concepts can be translated into stocks. When you're talking options, that's exactly how options work. You have the right but not the obligation. What I talked about with that jet fuel, that was the futures market. You have the obligation to deliver. If the price on that jet fuel goes way up, that dude on the other side, the investor or whatever thing is, he's going to get clobbered, and he can't get out from under it. So typically, options are a better option for us. So anyway, technical analysis. I mentioned this a little bit more. You know, historical price. These guys they look at charts, and it's just counterintuitive to me. I mean, it can be very useful. But the fact that you can scroll yourself away in a closet and not look at any of the future stuff that's going on and come up with a price, but they have these patterns, you know, cup and saucers and all these, you know, and this pattern and you know, Fibonacci stuff, and it's very interesting from a math perspective. But I don't discount it, but I do know that there's smarter people and smarter programs out there. If you think you're going to see a technical analysis program and be able to decipher some intuition before a computer, before a master, you know, mathematician already is on it, the big boys are already playing this game pretty well. The fundamental analysis, maybe not. Fundamental is look at the characteristics. This is more like a Warren Buffett type thing, you know. And again, you can be wrong, you know. Years ago when I was teaching this class, I said, you know, Crocs are a perfect example of those goofy little plastic shoes. I'm like, that is a company that's going to fail. That is a company I would short. And yeah, people wear those goofy little shoes more often than I ever would have thought. And so I you know, you can be wrong. You can think, oh, I've got this under control, and yeah, be completely wrong. Financial condition, all that data is available. Sometimes, though, you need to compare apples to apples. You know, you need to compare like NVIDIA to AMD. If you can compare NVIDIA to AT&T, it's just not going to work, because one's a big established company. They're both big companies now, but they have different, you know, the tech sector plays differently than the communications sector. It's just, so again, I usually rely on you know, third-party analysis. I can look at a balance sheet, but again, it's too much of a snapshot. You need to see the trend data. You need to see, you know, some of the other details, but it's all available to you. So here's, you know, a company doing well. Investors are confident. So stock price is determined by forward-looking It's what's the potential? If you're investing in some of these startups, Amazon was, people just discounted it, and that's why I traded Twitter all the time, because the people like Kramer, the idiot on Squawk Box, he hated it. He said, "Oh, there's no value. It's just, what do they sell? What do they do? How do they monetize it?" Well, there's people smarter than him who figured out exactly how to monetize it, and they did well. Amazon especially. Amazon lost money for years and years, but now, it's a huge cash cow. So this is what determines the price. Supply and demand. Accounting fraud. Well, it's always there. Manager compensation. People are, highly offended that some managers, some CEOs get such a income. They're like coaches on sports teams. If they get results, then they earn it. If you're overpaying the CEO, but he's keeping everybody employed, then maybe that's worth it. Anyway, I'm not going to say the comparison. All these comparisons have more to do with the fact that the line employees are not getting paid enough. You can argue the executive compensation is out of control, but I'm not going to defend that. But I'm just saying, if you're getting highly compensated and you're not producing results, then that needs to be reined in. GDP, again, getting into basic economics, fiscal policy. The fiscal policy is what countries like to try to control the private markets, and they can with some success. But if they kind of stay out of the way, things generally work out better. But in terms of setting interest rates and things like that, the way a country runs its own finances can greatly affect the markets. So, again, we're talking more economics than we are personal finance. So, obviously, stocks perform better, especially in the tech sector where they're borrowing a lot of money. When interest rates go high, tech stock sector gets clobbered. And some stocks definitely in the tech sector. Federal Reserve. It's a pseudo government agency, rife with conspiracies and all the rest of that. But they try to control interest rates, but supply and demand, the market cycles, they have a vote too. So the Fed can do what it can, but they'll take interest rates down to zero, but the market gets a vote as well. Plus, we live in a global world, so other countries can change interest rates, and it affects everything. So, but anyway, that's the monetary policy. It does. I mean, if the Fed comes out and cuts the interest rates by a couple of basis points, it has a huge effect, and we'll see interest rates where they'll try and raise the interest rates to slow down the economy and lower the interest rates to accelerate it, and whatever they do so with some success, but not always. Inflation. So that's what they're trying to keep. Now, keep in mind that these numbers are gamed. They'll take certain things in and out, and when you get, again, this is almost like the stockbroker on commission. When the government's in charge of releasing statistics, they're essentially doing their own grading. So, they'll take certain items in, they'll take certain items out, and they'll weight it differently, and they'll release bogus numbers, and they'll come out months later when nobody's paying attention, and they'll do a correction, especially during an election year. Very difficult. Industry conditions. This is, these are the guys that really get the vote, because this is actually the market that's doing it. If products are selling and the economy is in good shape, then things will kind of go the right direction. So, and then analysis. But again, you're always concerned with future performance. Stocks, today's stock price is based upon a forecast of what they expect that company to do in the future. So, yeah, stock price is going to go up. Low interest rates, low inflation. It's going to do well. Other companies, IBM or something like that, yeah, not so much. And this is why people get paid so much. It is difficult. And a lot of times, things are already priced in. You'll see, something that seems hugely positive for the market, and then you see the stock price go down. Unemployment's way down. This looks good. And you'll see the stock market go down. It's like, why'd that happen? Well, employment's up by 5%, and they expect it to be up by 6%. Or they already have that priced in, or you'll go nuts trying to outguess the market because because things are forward looking. People make forecasts in terms of what they think that is going to happen. So the market does not like surprises. That's when the market really goes down. Kind of on again, off again tariffs are really causing some havoc with the market. Again, is there a larger strategic goal? I'm not going to get into that, but I can just tell you that the markets like stability. They don't like fluctuations. Bonds, fairly short. I don't quite have the enthusiasm for bonds that I do for stocks. Bonds, so when we talked about stocks, we talked about an equity position. You own a chunk of that company, right? Bond is a big company, or in this case, could be a municipality, whatever, federal government, wanting to sell bonds, and it's essentially a loan. They don't want to give up any equity. They don't want to sell any part of their company. They want to just get a loan. And so they'll issue a bond. And so, yeah, long-term debt security, debt, not equity. So say it's a $20,000 bond, and it's going to mature in 10 to 30 years. So, whatever, it'll say what it is. Say it's a 20-year bond. It's going to pay you, 3%, meaning it'll pay you 3% of $20,000 every year for 20 years, at which point they give you your 20 grand back. Bada bing. Done. Now, this bonds can be traded. So you can buy the original issue bond, or you can buy it again on the secondary market. Now, once it's on the secondary market, and let's say you have a 3% bond, but there's new bonds that are paying a 4% yield, well, all of a sudden your crappy 3% bond isn't as attractive. So you go to sell your bond on the secondary market, people want to give you $17,000, $18,000 for your $20,000 bond, because even though you'll get the 20 grand back, at the end of the period, in the meantime, you're going to be taking this suboptimum interest rate. Conversely, if you're holding on to, say, a 5% bond and the current bonds are being sold for 3%, people want your bond, so they're going to pay more for it. So, but anyway, they're always in this low interest rate, and so it's just, they'll outdo inflation, and there's guys who sell bonds, and they make some money on that, but not so much on the actual holding of the bond. They make it on trading the bonds. Call feature, not good for you, meaning, let's say you got the 5%, you're pretty happy you've got this bond's paying 5%, and all of a sudden the bond issuer says, I'm getting screwed here, I could reissue these bonds at 3%, I'm calling all those other bonds back. And so all of a sudden, because there was a call feature, that gave that seller the option to just call the deal off and say, yeah, no, this isn't working out for me. So yeah, call feature's not in your benefit. Convertible bond can be converted into stock. You can convert these things back and forth if that feature's available. And yeah, there's going to be a little something less. So this is what I was talking about, where it's going to pay that. You're going to get your $20,000 back if you hold it. If the yield is higher, whatever. Things will change. The it's not a snapshot. It's a tradable instrument once it's out there. You can look on different resources for more explanations on bonds. Yep, this is what I was talking about. Brokerage firms. So again, I've never bought bonds. I don't know whether I assume you can do it commission free. It's just not as popular. And sometimes people do it. Sometimes people say, oh, you should diversify. You should have some bonds. I'm not, whatever. It's like cars. Do I want to buy a, whatever, I don't mean to badmouth anybody, but do I want to buy some other brand of car just so I can have? No. If it's not something I want. The diversification for diversification's sake is not great. The car example is probably not a good one, but anyway, I want to diversify smartly. I don't want to diversify just to say I did so. But the people would diversify if they thought that if the stock market went down, bonds would still stay high. That might make some sense. But anyway, T-bills. So these guys are insured by the full faith and credit of the U.S. government. So how much risk are you taking? Not much. If the U.S. government goes down, we're all screwed. So probably not going to happen anytime soon. So is it going to keep up with inflation? Probably not. Just sort of a parking place. So a good place to maybe hold some money, but again, you're not going to be exceeding inflation by much, if anything. Munis. Sometimes these have tax interest type things where they're exempt from federal income tax. If you're in that high tax situation, if you're somebody small, not making a tremendous amount of money, you're probably not paying a high federal income tax. I mean, they're talking about eliminating federal income tax for people making less than $150,000 a year, which would make this whole thing kind of a joke. Now, that's political talk at this point. If they put it into action, that'd be one thing. We'll see. Federal bonds, but insured by federal agencies. And these could be also federal mortgage type things. Fannie Mae and some of these acronyms that have to do with government mortgage bonds. Corporate bonds. Okay, now you're dealing with a company. Bigger risk. Yeah, they could default. Much more likely. But they're going to pay you a higher yield. Now, I've held short-term bonds that were high yield. And if somebody's trying to sell it to you, they're going to call it a high-yield bond. If you're trying to sell it, somebody will probably identify that as a junk bond. So it has a lot to do with the vocabulary. They're both the same thing. It just depends whether you're buying or selling. But yeah, if a company's not doing well and they're paying some phenomenal bond rate, that's because they have to. Nobody wants them unless they're willing to really pay a high yield. And so it could be a good investment if the company stays around, but it could be horribly wrong if they just default. So they're graded. And again, there's tons of grade inflation. If anything's below, if it doesn't have an A in it, you probably shouldn't be buying it. I think down in the B's, we get down into junk bond status. They're graded like AAA plus down to whatever. There's a couple different people. We'll talk about the way that's done. So bond quotations, coupon rate, maturity, yield, volume, closing price. So just like a stock ticker. And again, you can follow these on charts. Impact of interest rates, just what I talked about. Yeah, if interest rates are going up, they're going to have to offer a higher yield. If interest rates are going down, and so it makes a difference, especially when it's going to affect the value of the bonds that you have in your portfolio if you do. Tax implications, yep. Ordinary income, and then also capital gains if you happen to make some money like that. Valuing a bond. I got a puppy that's just yawning quite loud. May or may not be true. So anyway, how's the company gonna do if it's a corporate bond? Default risk. This is where they just quit paying. Now again, you don't have an equity position. You've got a a debt position, so you can go after the company. But if it's a company that's failed, yeah, good luck. Now here's the different ratings. So you got Moody's, Standard & Poor's. There's other rating agencies out there, but these are kind of the big boys. And they both have their charts or their grade scales that are semi-similar. One will be AAA, all caps. One will be AAA plus. Anyway, we'll look at that in a second. Yep. Yeah, bonds have defaulted sometimes. And higher default, obviously, just like in the stock market. You're not immune from that. If you're invested in bonds and the companies are failing, you may not fail as hard, but you're still failing. So here's Standard & Poor's. They go with AAAs. Moody's, okay, they're using lowercase. And then anything below a BB is down in the junk category, meaning that, if you're buying DDD, you're throwing your money away. B, maybe if you look at a shorter term bond, maybe that'll work for you. I was getting 8% on a short-term bond fund I had, and it was fantastic. I mean, it was just like a steady payment every month. I don't know how much money I had invested with them, but it was like, just maybe say $10,000 or something like that. And I was just getting an extra $800 every month, just as income stream. It was sweet. And anyway, at some point I sold it. I think interest rates started to come down, and because it was a short-term bond, they were starting to march the interest rate down. But it was good while it lasted, and it was a mutual fund bond, so it was a variety of companies. So that diversification, even though it was probably down in this B range because there's multiple companies. Sure, there were probably a couple companies that failed, but some stayed in it. I wasn't all mired to one company. So we'll talk about mutual funds. And so don't get too wrapped up going, look, I'm never ever going to trade individual stocks. Why do I need to know this? You kind of do, because when you're trading mutual funds, the underlying assets are typically stocks, in some cases bonds. So when you're reading through a prospectus, the kind of the rules of the road for your mutual fund, and they're talking about some of these different trading strategies, you'll know what they're talking about. If you don't know what they're talking about, then you're just, blindly kind of guessing, and it's not a strong position for you. Call, yep, we talked about that. That's where they just say pay it all back. Interest rates changes, that can also change. And then maturities, yeah, you can set these up. I'm putting this $20,000 in. I don't need it till little Johnny goes to college, so I want a 20-year maturity because the kid was just born. So midway through college, assuming he goes to college, that point, boom, you get your $20,000 back. Nice. Yeah. So different strategies. If you expect if you see interest rates really high, they're paying a high thing, there's no call option, yeah, it might be a good idea. Held for a long period of time. Again, sort of on autopilot. You did some research, you made your call way back when, and now you're just sitting back collecting those fat checks. Maturity strategy. Can't see the puppy I got that's obsessed with a squirrel that's outside. Anyway, I did the term paper. So, term paper, you should be getting going on that. Again, look at it. Use these brokerage type things. We're going to talk about mutual funds next week. I'll be talking about a lot of these different sites for the different companies that you can feel free to go out there and explore them. Go to Fidelity, go to Vanguard, go to T. Rowe Price, go to whatever company you're associated with, whatever one you like, and look in their research section, and you'll find all sorts of calculators and cool things that will help you with some of these financial decisions. So that's about it. Talk to you next week.